Welcome back to the channel. By now you understand the basics of investing in stocks and mutual funds. But how do you actually choose which individual companies to invest in? That's where fundamental analysis comes in. Fundamental analysis is the process of evaluating a company's financial statements and health to determine its underlying intrinsic value. It involves analyzing key metrics like revenues, earnings, assets, liabilities, cash flows, and management strategies to gain insights into the company's potential for future growth. Conducting a thorough fundamental analysis is crucial before investing in any stock, as it helps identify quality companies that are financially sound and have upside potential. Why does this matter? Because fundamental analysis helps you identify stocks that are potentially undervalued or overvalued. It allows you to spot opportunities and make informed choices, minimizing risks in the volatile world of investing. Fundamental analysis is the foundation of intelligent investing. It involves evaluating a company's financial health, management, competitive advantages, and market position to determine its intrinsic value. Let's dive deeper into the importance of fundamental analysis. The importance of fundamental analysis in stock selection and investing cannot be overstated. Here's a more in-depth look. 1. Determining intrinsic value. Fundamental analysis allows investors to evaluate a company's intrinsic value based on its financial health, earnings potential, and growth prospects. By analyzing factors like revenue, profit margins, and future cash flows, investors can estimate the true worth of a company. This valuation forms the basis for informed investment decisions. 2. Long-term investment decisions. Unlike short-term market speculation, fundamental analysis focuses on the long-term viability and growth potential of a company. It helps investors identify stocks that have strong fundamentals, sustainable business models, and robust competitive advantages, making them suitable for long-term investment. 3. Risk management. Fundamental analysis assists in managing risks associated with investing. By assessing a company's financial statements, debt levels, and profitability ratios, investors can gauge the financial stability and risk exposure of a company. This insight helps in mitigating risks and avoiding potential pitfalls. 4. Identifying undervalued stocks. Through fundamental analysis, investors can identify undervalued stocks that are trading below their intrinsic value. This presents an opportunity for investors to buy stocks that have strong fundamentals but are temporarily undervalued by the market, offering the potential for future price appreciation. 5. Making informed decisions. Fundamental analysis provides a comprehensive view of a company's health, encompassing its business model, competitive positioning, management quality, and growth potential. Armed with this information, investors can make well-informed decisions rather than relying solely on market sentiment or short-term fluctuations. 6. Building a diversified portfolio. By understanding the fundamentals of different companies across various industries, investors can diversify their portfolios effectively. This diversification spreads risk and helps in creating a well-balanced investment portfolio that can weather market volatility. In essence, fundamental analysis is a crucial tool for investors, enabling them to make rational, informed, and calculated investment decisions that align with their financial goals and risk tolerance. It forms the backbone of successful long-term investing strategies. So let's dive into the key steps for conducting fundamental analysis. 1. Review the company's financial statements. The starting point is to obtain and review the company's annual and quarterly financial statements, which are publicly available on the company's investor relations website or finance portals like Yahoo Finance. These include income statement, shows revenues, costs, expenses, and profits over time. Key metrics include revenue growth rates, profit margins, earnings per share trends. Balance sheet. Snapshot of assets, liabilities, and shareholder equity. Key metrics include debt levels, cash position, receivables, inventory levels. Cash flow statement. Shows cash generated and used by the company. Key metrics include operating cash flow, cash from investing, financing activities. Analyze trends in key metrics like revenues, profits, margins, cash flows over the past 3-5 years to gauge the company's financial performance and growth trajectory. Compare metrics to industry peers as well. 2. Understand the business model. Study the company's business segments, products, services, target markets, competitive landscape, moats. Understand sources of revenue and profitability. Key questions to ask: is the business model scalable? Does it have network effects or other advantages? How dependent is it on specific customers, products? What's the concentration risk? What macro factors drive demand? How resilient is the business in downturns? How strong are barriers to entry? What's the threat from new competitors? Does management have a clear strategy for future growth? This will help assess the quality and sustainability of the company's earnings power. Favor businesses with durable competitive advantages. 3. Analyze management and corporate governance. Evaluate the management team based on their track record, strategy, communication with investors. Key things to assess: experience and competence of the management team, alignment of management compensation with shareholder returns, history of value creation through capital allocation decisions, transparency and accuracy of disclosures, board independence and oversight of management, related party transactions and potential conflicts of interest. Strong management is vital to a company's long-term success. Red flags on governance are a sign to stay away. 4. Check industry and market growth outlook. Assess demand dynamics in the company's served markets and industry. Key factors to research: industry size and expected growth rates over the next 3-5 years, impact of technological changes on industry structure and competition, sensitivity to macroeconomic and regulatory changes, barriers to substitution by new products, services, bargaining power of customers and suppliers. Favor companies in expanding, high-growth industries less vulnerable to economic cycles or disruption. 5. Compute financial ratios and metrics. Compute various financial ratios to evaluate operating efficiency, profitability, leverage, valuation and growth. Some important ratios include: gross, net profit margins, measure operating and net profit efficiency, return on equity, ROE, gauges profit generated from shareholder funds, debt to equity, assesses financial leverage and credit risk, PE, PB, PS ratios, help determine stock valuation, revenue, earnings growth rates, indicate business momentum. Compare ratios to peers as well as the company's own historical trends. Look for consistent improvements over time. 6. Build forecast financial statements. Develop 3-5-year forecast income statements, balance sheets and cash flow statements based on reasonable growth assumptions. Account for factors like revenue growth from new products, markets, pricing, cost efficiencies from economies of scale, impact of planned capital expenditures, changes in working capital needs and debt repayments and equity issuances. This will give you an idea of the company's potential earnings and cash flows in the future. 7. Calculate intrinsic value and target price. Use valuation techniques like discounted cash flow analysis and relative valuation, PE, EV, EBITDA multiples, to arrive at an estimated intrinsic value per share. Compute the upside-downside potential compared to the current market price to see if the stock offers a margin of safety. Re-evaluate your thesis and target price periodically based on company developments. Conducting thorough fundamental analysis takes time but is crucial for making well-informed investment decisions. By analyzing both qualitative and quantitative factors, you can identify high-quality companies with strong competitive positions and earnings potential to generate market-beating returns over the long run. Let me know if any part of the process needs more explanation. Fundamental analysis isn't about predicting short-term price movements. It's about understanding the company's true value. By mastering this art, you can make more informed decisions, building a robust portfolio over time. Thanks for watching. If you enjoyed this video, give it a like and let us know in the comments which stocks you will be analyzing. Subscribe to Money Matters, Mastering Finance and Investment for more investment and personal finance insights. We'll see you in the next video, and as always, stay financially savvy.